We got the PPI data, and this is the data that everybody was nervous about. And basically, in the PPI data, we got confirmation that the last PPI that actually was much higher than anticipated was very transitory and probably because of the tariffs. And now the PPI has come down from 3.3 back down to 2.6, which means that the inflation is pretty much not the biggest problem. And in fact, what that also means is that Powell's basically very much behind the curve, and that he has no choice now but to try and catch up to the curve. That's not the only reason why Powell's behind the curve, and what you can see now is that the markets are starting to realize it. And I want to show you there's an undercurrent in this market of what the market's starting to realize around the part of the cycle that we're at. And when you realize what's actually going on, I think you're going to realize that not only is Powell late, but it could also mean that we're late. So today's going to be a massive show, and it's all about how Powell has no choice but to go full risk on very quickly. It's going to be a massive show, guys. Let's get the show on the road. I'd go as far as to say that the last 24 hours in crypto have actually been, or in markets, have actually been crazy and absolutely pivotal. I mean, you saw what happened yesterday. The job numbers got revised down, and when the job numbers actually got revised down yesterday, the Bitcoin price went down. I was like, guys, this Bitcoin price is going to go straight back up, and here we are straight back up again. I'm going to dig into all this data because there's actually a lot going on with this data. There's talks of a recession, there's talks of stagflation, there's so many big buzzwords being thrown around. Ultimately, for us, I mean, if you don't want to watch the show, you just want to go from here to the very end of the show. What the events of the last 24 hours mean is it means that the markets have the full license to go full risk on very quickly. And so I think yesterday and today were massive turning points for the market. And again, as I say, if you don't want to watch the show, just the TLDR of the whole show is that the market has a license to go full risk on. For those of you who do want to watch the show, I have one ask, and it's the same ask that I have for you guys every single day. I think what you guys don't know is that I know you think that I just arrive here and I switch on the camera and I bring you a show and it's always filled with alpha. I think what you don't understand is in the background, we've got 10 researchers working on the show. And ultimately, it takes me about 4 hours to bring you guys a show every day. We have a research call every morning for an hour. We then work for 2 hours before that, the show, to prep the show. And then we do the show, which takes now, it's 4 hours a day. All I'm asking of you is that you hit the like button. That's it. And if you're not already subscribed, subscribe to the channel. It's so simple for you guys, but it makes such a big difference for us guys. And it gives us massive distribution. Wow, Hottest, that's quite a nice button you've got there, bro. Very nice. All right, let's not waste any more time. I'm counting on you guys for the likes, more alpha. I'm going to show you why it's time to go full bull risk on mode. And of course, it started off yesterday, but we're going to start off today. It started off with the PPI numbers. Remember, the PPI numbers last month were very scary. Why? Because the PPI numbers last month had a massive jump. We went from 2.3% in June to 3.3% in July. And this is the number that basically scared everybody away. And this is the number that made people nervous. And now people were expecting the worst. You can see that the markets were actually expecting the worst. They were expecting another 3.3% reading. The truth is, though, that the numbers came straight back down, and the numbers came back down to 2.6%, which is what we actually got today. And what that shows is that the inflation that was shown in the PPI numbers, the producer price index numbers, were very temporary and very transitory, and was probably linked to the tariff tantrum that Trump had at the tariff tantrum that Trump had at the beginning of the year. And now that the talk about tariffs has started to disappear, what you're starting to see is that the inflation is actually starting to come down. And that's exactly the license that the market needed, or the license that Powell needs to start really cutting rates. Tomorrow, we have another data point, which is the CPI data. Now here, I wouldn't be surprised if there's a slight tick up in CPI. And the reason why I wouldn't be surprised if there's a slight tick up in CPI, which is, by the way, what most people are forecasting, is because when you have high PPI in a previous month, those goods need to flow onto the market, into the consumers. So this inflation that was felt in the producer price index earlier is now going to be felt in the consumer price indicator slightly later. What you would then expect is you would expect the markets to actually start coming down, or the inflation to actually start coming down, because remember what PPI is. PPI is producer price index. It is what producers are feeling as an increase in price when they're producing goods. Those goods need to get to the shelf and get to the consumer, and there's usually a month or maybe a 2-month lag between that. So I kind of agree with these expectations. I think tomorrow in the CPI we get 2.8, 2.9%, and then I think after that we basically start going down. And so I think now the rate cut is all but confirmed, and the only question that we have is how big. Let me just go back to the rate cut here. The only question we have is how big will this rate cut actually be, right? Because we have one school of thought that says, okay, well, you know, the first rate cut, the 25 basis points rate cut, is confirmed, pretty much confirmed. There is a possibility of a 50 bips rate cut or a double rate cut happening. And I want to show you where the majority of this possibility is coming. And actually what I think is that this is actually going to be a much, much, much higher probability. So let me show you where I'm getting that data and why I think we may get more fuel onto this Fed fire that's about to start. So it starts off yesterday. And I don't know if you guys were watching the markets yesterday. I mean, I assume you were, because you're all a bunch of fucking degens. But I assume that you know that what happened yesterday was that the Fed, or that the US Labor Department revised the jobs numbers by minus 911,000 jobs in the last 12 months. Now, what does that mean? It pretty much means that over the last 12 months, 911,000 jobs that were reported during the Biden administration actually were never, ever, ever created. And when they re-looked at the data, they realized that, hold on a second, actually, these jobs never existed. Effectively, what it means is that 2 million jobs from the last 3 years of the Biden administration have now been revised away. And it's the biggest revision since the Great Depression. So it's quite a big thing. It pretty much stinks, to be honest. It means that the Biden administration, or during the Biden administration, I'm not going to say that it was only the Biden administration, during the Biden administration, 1 million jobs which claimed to have existed didn't exist. Which means that during the Biden administration, the performance of the economy, because remember, the economy is mentioned in the growth of the economy, GDP in terms of or sales and stuff like that, but also how many jobs are being created. And whatever the jobs that they reported, well, the jobs that were actually created were 1 million under the jobs that they actually claimed. Now, remember that a lot of decisions were actually taken on these jobs numbers. And now we're revising the data 1 year later, or almost a year later, and it's showing that it's actually showing a few things. The first thing is it's showing that the jobs were overstated. The second thing is it's showing that the state of the economy was overstated. And as a result of the fact that the state of the economy was overstated, Scott Bessent actually warned us a week ago. He said, look, the economy that Trump is inheriting is actually much worse than what you guys think it is. He warned us that these jobs would be revised. Listen to this.
Mr. Secretary, you know, the economy did add nearly 500,000 manufacturing jobs under former President Biden. In this case, since April, again, you're actually losing manufacturing jobs. Is that problematic for your policy?
Well, a couple of things, Chris. We're going to get the revisions for last year next week, and there may be as big as an 800,000 job downward revision.
So he warned us about this. He warned us about this, and he said, look, there's going to be a massive downward suggestion. And basically what this shows is it shows that the Biden administration handed us an economy which wasn't actually as good as they said it was going to be. It could also mean that the Biden administration was maybe working with the people that provide the numbers, and it said, and actually over-reporting the numbers to make the economy seem healthier, to actually get more votes. Trump's claimed that publicly many, many times. As you can read here, it says, Mr. Trump claimed that Mr. Powell cut rates just before the election to try and help Kamala, or whoever it was trying to help, whoever it was trying to help. He's not the only one that said that. David Sachs actually said it on the All In pod, and it's quite long, but I want to
kind of push back on this shibboleth that the Fed is strictly apolitical. All the Fed governors are politically savvy and connected people, and they understand the politics of this. And the best example is Powell himself. So let's just go back through the history. So in the summer of 2021, we got that 5% shock inflation print. And it was Powell who played along with Biden and Yellen that this was transitory. And that transitory narrative they used to basically avoid any interest rate cuts or any change of policy for 6 months. Now, what was the importance of that timing? Well, Powell was renominated for a second term by Biden on November 22nd, 2021. So in other words, he went along with this whole transitory narrative to get renominated by Biden. And then a week later, on November 30th, he said it was time to retire the word transitory. And he then essentially announced that there'd be a policy shift, and then they didn't raise interest rates for another several months.
And it was a historic tightening cycle, meaning the shock to the economy was incredible because the rate and the velocity of which he raised rates was unprecedented. So the real question is, had he been truthful going into a nomination process and done it much sooner, would the economy have been better off? And the answer is probably.
Yeah, for sure. Because in that second half of 2021, we had a bubble. We had an asset bubble. We saw it in startups. We saw it in real estate. And that bubble was caused not just by artificially low rates, but also by...
In the rest of this, in the rest of this thing, I'm not going to make you listen to all 3 minutes of it, even though we are listening to it in 1.2 speed, 1.25 speed. They do accuse the Biden administration of working together with the Fed, which is supposed to be a non-political organization, to actually keep the Biden administration in power. What this also means is that for the first time that the American jobs market is actually in a crisis. And actually, for the first time since the COVID pandemic lockdowns, there are more unemployed people than job openings in the United States. That's a very, 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 very scary stats. That number hasn't been like that since COVID. It said in July, the USA had 7.18 million job openings for 7.24 million unemployed people. So what this shows is it shows that the rate markets, the labor markets are in an absolute mess. And so at face value, when you look at this thing at face value, for us specifically, this should be a very, very, very good thing, right? Because what it means is that the Fed is actually behind, and that they actually need to stimulate the economy, right? And if by them stimulating the economy, it means that our assets will actually go up. So then the question is, well, why, when this was reported yesterday, why did we get this big red candle that took us from 113,000 all the way back to 110,500? So the reason why it happened was not because the data is good or bad for the economy. The reason why it happened was because people lost trust in what's going on in the United States. And the reason why they lost trust in what's going on in the United States is because remember that the Fed keep coming out and saying, look, we're a data-dependent organization. We make decisions based on the data. And Trump and Powell is the one that always stands up on that podium and he says, look, we're going to rely on the data. We're going to make decisions based on the data. We don't care what Trump wants and what Powell wants and whatever else. We make decisions based on the data. All right, dude, if you make decisions based on the data, but the data that you have is all wrong, then what are you making decisions on? That's what made the markets nervous. That's why we got this big red candle over here. Because the market was kind of looking at this and going, all right, this is the organization that is non-political. It is only making decisions based on smart data. All right, cool. If you're making decisions based on data and all the data that you get keeps being revised and is always wrong, that is when markets get nervous. And if there's one thing markets care about more than rate cuts and stuff like that is unreliability and not knowing. And that not knowing is what actually caused the markets to do this yesterday. And I think Besant has the same a view as I have here. He's like, listen, if you guys are working off data and your data is not correct data, then what are we actually flying on? Imagine this. Imagine that you're supposed to be flying an airplane and your GPS is broken and you're working off a map, but your map's wrong. Then where the hell are you flying to? How am I as a passenger supposed to trust that you are flying me to the right place, right? And so that's exactly what Besant is saying over here.
If the Fed says they're data dependent and the data has been atrocious, then it seems like there's probably some makeup cuts in order here, or the size of this month's cut needs to be recalibrated. And
so you can see he's like saying, look, well, if you're working off data and your data has been wrong to the tune of 1 million jobs, then you guys are very, 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 very far behind the curve, right? Chamath also said the same thing. He says, look, let's just call a spade here. The Fed is woefully ill-equipped to set monetary policy in an economy as dynamic as the US in 2025. And I think he's got a point here. Like, I've always been on the Fed side here, and I've always said, look, keep the Fed independent and don't politicize the Fed, and Powell shouldn't crumble for Trump. But hold on, guys. If our plane is on a course that is backed by a certain map, and that map is completely wrong, or the data they're getting in terms of where we are in our flight path is completely wrong, then I'm very scared to be on that plane. I got to be honest. And I don't trust the pilots. I don't trust the Fed because they're working on data and their data is very wrong. And that's why the markets actually went down yesterday and everybody started bailing. When we saw the PPI data, the market realized something else. And I'll show you in a second exactly what the market started to realize. More importantly is that the market is starting to lose trust in the Fed. The Fed were late to cut rates, to increase rates, and that's why we got into the inflationary cycle. And now the market is very, very much worried about the Fed cutting rates. They're very worried that the Fed is very, very much behind the curve. Also, if you remember, in the last administration, Yellen and Powell were very close. You had the US Treasury Secretary and the Fed board the Fed chairman working together to make the plane fly. But now you've got the situation where you've got Bessent, who's basically calling Powell an idiot. And then you've got Powell here. And what they don't like here is they don't like the fact that no one can trust the Fed, and even the Treasury Secretary can't trust the Fed. And that is why the markets got very, very, very nervous yesterday. And you know what? Trump's right. He said, and Chamath calls it out, he said, we're now firmly behind the curve. Now there's no denying it. I was always like, maybe we are, maybe we're not. Now there's no denying it. Now we are behind the curve. We're very, very, very much behind the curve. And Trump is actually right. If there were 1 million jobs that were faked or wrong or whatever you want to call it, for now, let's just give them the benefit of the doubt, they were wrong. Then we are very, 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 very late in the cycle. And what Trump said, if the Fed had followed what we published, they would have raised rates. They would have raised rates in early 21. The entire organization had broken. It needs to be fixed. They need to use modern sources of information. We strongly disagree with Ken Griffin. We think incompetence is more important to defend than theoretical independence. And that's around the argument of whether the Fed should be independent or politicized. And I think now Trump is actually very, very vindicated. Now, look, this is not the first time that jobs data has been revised, but the last time that jobs data was revised, which was exactly a year ago. If you look on the 18th of September, 2024, amazing what an 818K downward job revision did. Nobody could have seen. And that is what caused the 2 rate cuts. The last time we had an 818K downward jobs revision, we got the whole dot plot moving 1 level down by all the Fed members, right? So all the Fed members basically said when they got a revision the last time when Kamala was about to be voted for who God knows what reason, they all reduced the dot plot to make as if, or because at the time they felt that they were much more bullish. And so now the big question is what happens next week at the Fed meeting? Because it is a quarterly Fed meeting and there will be a dot plot next week. And when there is a dot plot next week, are they all also going to revise down saying that the rates are going to come down quicker? Because they did last time when there was a negative 900. And so now the jury's out here as to whether we're going to get a 50 bips rate cut, which is on Polymarkets what they're saying, or a 25 bips rate cut. Right now, it looks like we're going to get a 25 bips rate cut. But there is a big chance for a 50 basis points rate cut. And the reason why there's a big chance here is because the last thing that Powell wants to do, the last thing that Powell wants to do is go from inflation to recession. Because the first time he failed, and you could blame that on COVID, you can blame that on increasing prices and whatever else. The second time, you don't want to go from under your watch. You don't want to go from an inflationary scenario to a complete recessionary scenario. And the bad news is, or the good news is, or the bad news is, or the good news is, when you look at the jobs market is actually telling us that the jobs market is in a recession. So this guy says, are we already in a jobs recession? Less than 50% of industries are adding workers in the last 6 months, which means that less than 50% of industries right now are in an expansion mode. And that could mean that we're in a recession. That could mean that we're in a recession. And the reason why I said that could mean that we're in a recession, remember that a recession is only declared when you have 2 periods of decreasing GDP data, right? Or decreasing growth on GDP data. Now, the problem with that is that recessions are actually announced on historical data. And so in order for us to deem it to be a recession, in order for us to make the announcement to say, hey guys, we're in a recession, we need to get data for 2 quarters where the GDP actually goes down. The problem is that that's historical data, and that's going to take time to come out. And so generally, by the time you find out that you are in a recession, you've actually been in a recession for the last 6 months. But it just takes time for the data to actually tell you that we're in a recession. And that's the big fear now. The big fear now is that we actually are in recession. And that, by the way, is what our friend Hendrik has been saying for a while. He's been saying, look, we're at the last part of the contraction and we're in the beginning part of the recession. We're going into the beginning part of the recession. And so right now, there's 2 fears. One is a much bigger fear than the other. The first fear is that we're in a recession. Powell doesn't want a recession. By the way, that would be a good fear. A good fear is that we are actually in a recession. I'm going to show you why in a second. A bad fear is that we're in stagflation. Now, for those of you who don't know what stagflation is, it's when you have increasing inflation and slower growth. So if you have usually when you stimulate an economy, you get inflation, but you also get growth. If you stimulate the economy and you get inflation, but you don't get growth, that is what they call stagflation. Now, as I said, I could live with a recession, providing it's not a bad recession. And the reason why I say that is because recessions are not all bad. And the reason why I say recessions are not all bad, obviously, if you have a monster recession like the Great Depression, that's very bad. Lots of people lose their jobs. It's very, very, very tough on markets, etc., etc. However, not all recessions are long. Not all recessions are created equal. If you look at what recessions look like, we had a recession for 2 months in 2020. We had a recession for 6 months in 1980. So recessions can be very short periods of time. And usually by the time you get the data, you're 6 to 8 months after the recession anyway, right? And so to me, a recession, providing it's a mild recession, is actually not a bad thing. And the reason why a mild recession, is not a bad thing is because the only way to get out of recession for the Fed and for any central bank is to stimulate the way out of recession. How do they stimulate? They can put more money in the economy or they can reduce interest rates. That's the only way to get an economy out of a recession. And so if the data points to the fact that we are in a recession, and by the way, the data is already pointing to the fact that we may be in the early stages of a recession, very, very, very early stages of a recession, believe it or not, then the good thing is that the only option that the Reserve Bank or that the central bank actually have is to stimulate their way out of it. Now, what happens when you stimulate your way out of it? Well, that is when markets actually start running because they either move from quantitative tightening to quantitative easing, or they reduce interest rates, or they somehow put more money, somehow through helicopter stimulus or whatever else, they put more money into the economy. And so I think for me right now, the best case scenario is that the Fed believe that they are late and going into recession, or that the early data starts to point to the fact that we're getting into a recession. When I say the early data, I cannot wait for the GDP numbers to come out and be negative for 2 quarters in a row. The reason why I can't wait for that is because by that time we would have been in a recession for 6 months, and that's not very good. And so generally, because the only way to get people out of a recession is to stimulate the way out of a recession, investing in recessionary periods has actually been one of the best investment strategies in the world. And if you did do that and you invested during recessions, in the year after the recession, you would have made 18% on stock markets, not Bitcoin. On 3 years, you would have made 46%, and on 5 years, you would have made 120%. which kind of shows that if we are going into a recession, the Fed's going to have to stimulate. And when they stimulate, they're going to have to kickstart the economy or the risk asset bubble. And when they start the risk asset bubble, that turns out to be the best time to actually land up investing. And so now that there's not much inflation and that the Fed is very, very, very much behind the curve, I think that we're actually in the ideal situation for risk assets. Not for every asset, but specifically for us. And we're playing out in the bottom of the risk curve, the far end of the risk curve, right? Or the most risky assets. I think for us, this is the best opportunity. No inflation, and the Fed way behind the curve, panicking about the fact that there may be a recession. And I wouldn't be surprised if by the time we get to September, the odds of a 50 bips rate hike actually go up quite a lot. I would imagine, and I'm going to put my head on the block here, and I'm going to say, look, I would imagine that by the time we get to September, this is on 20 or 30%. And look, let's wait for more data. Maybe more data will actually get us out there and get us more towards this 50 basis point rate, the 50 basis point rate cut. And that is the thesis for today. The thesis for me for today is that Powell is now trapped between a rock and a hard place because he's been following the data, but his data has been absolutely wrong. And we could be moving into a recession. He doesn't want a recession because he was the guy who got us into inflation. And he doesn't want to be late again. And so probably his best bet is to do what they did for Kamala. We're not asking for much. We're just saying, look, just do what you did for Kamala. You revised down by 50 bips. Just give us 50 bips, like with Kamala. It's simple. Not asking for much. What you did for one, just do for that. Pretty simple. By the way, this is already happening in the markets. I know you can't see it, but actually I'm going to show you that we're not the first people to identify this. And actually markets are much smarter than us. Markets have already identified the fact that this is happening. And you know how I know that? Because what we know in periods of financial loosening and periods where the Fed and the central bank is trying to stimulate the economy to try and catch up, what we know is that risk assets outperform non-risk assets during that period of time. It's a pretty simple thing, right? That's why in the peak of the interest rate cycle or the loosening cycle, you get the altcoins actually outperforming Bitcoin. And that's usually when we get the blow off top, right? And so what if I told you that this market has actually known this for the last couple of weeks? I know you don't believe me, right? And the reason why you don't believe me is because you're looking at the wrong chart. You're looking at Bitcoin. And you're looking at Bitcoin and you're saying, hold on a second. If this is true, right? If this is true, then, well, why hasn't Bitcoin gone up? You're looking at the wrong chart. Because remember what I said. In periods like this, the market favors risk assets over safe assets. And if you think about where we're at in the cycle, I know Bitcoin is not where you want it to be, but the altcoins are already outperforming Bitcoin in the last couple of weeks. Yeah, I know that Bitcoin hasn't had this face melting pump that you want and that your favorite influencer told you was going to come. But the market doesn't really care what you want. The market is telling you with the data that you're wrong. Why? Because remember, I said in periods where the Fed is expected to financially loosen, the risk assets outperform the safe assets. The riskier assets outperform the safer assets. Now I want to show you what's happening in the last 90 days. We're getting into alt season. The alt season indicator is the highest that it's been in the cycle. 69, I think it's 69%. 69 of the altcoins have outperformed Bitcoin. And for the first time in this cycle since January, the first time since January, the altcoins are actually outperforming Bitcoin, which means that the market is starting to tell you that the risk assets are starting to outperform the safe assets. And you can see it in the individual charts. Here's the individual chart of ETH or SOL versus Bitcoin. And SOL has been outperforming Bitcoin since the beginning of August, right? That's the last month. Look at ETH. ETH has also been outperforming Bitcoin since May and much, much, much more aggressively in the last couple of periods. If you go to Banter Bubbles and you go to this settings tab over here and you set your base currency as Bitcoin, what you'll notice is already for the last month, there have been a lot of assets, unusually high number of assets that are actually outperforming Bitcoin. Here's some of the big assets that are outperforming Bitcoin. Link has outperformed Bitcoin. ADA has outperformed Bitcoin. WorldCoin outperformed Bitcoin. OKX outperformed Bitcoin. This one I'm going to pop. Mantle outperformed Bitcoin. Pith outperformed Bitcoin. Hyperliquid outperformed Bitcoin. What you're starting to see is that the market's starting to tell you something. Even Doge actually outperformed Bitcoin. Doge outperformed Bitcoin. Guys, there's a Doge ETF coming tomorrow. Did you know that? There's a Doge ETF. Doge ETF. You know, I'm going to give you a little bit of we're going to carry on to the show, but I'm going to give you a little bit of alpha on the day. Just a little bit of alpha on the day. I probably shouldn't be doing this. So let me just hide my screen here because I probably shouldn't be doing this because it's actually, I'm breaking news a little bit early, but I'm going to do it because I always do stuff like that. And then, hold on. Okay, go and look at this token. It's called a non-coin. It's a small launch, a meme coin launch, a meme launch pad, right? The only thing is this is going to be built on Doge chain. Doge chain is not launched yet, but there's going to be a new chain called Doge chain, which is a layer 2 on Doge. And this, a non-coin, is the meme coin launch pad, or the probably the favorite meme coin launch pad. Anyway, we digress. So going back to it, we are in a period of where the market's telling us that risk assets are starting to outperform the safe assets. I know that Bitcoin isn't where we thought it's going to be in the cycle, but the market doesn't care where you wanted to or what your expectations were. The market moves in forces. And in a period where the Fed starts loosening and we get more aggressive monetary policy, what you'll see is the risk assets outperforming the safe assets. And we're in the beginning or the middle stages of it because already 69 of the risk assets are outperforming the safe asset, which is Bitcoin in crypto. What I'm expecting the same thing to happen in the Russell 2000. I'm expecting the Russell 2000 to start outperforming the NASDAQ. So maybe if we can just do a chart like that and say Russell 2000 divided by NQ, or maybe even better is SP 500. Let me see if we can actually generate a chart like that. You'll probably see that in traditional markets as well, in this part of the cycle, let's see if it'll actually generate that chart for us. You'll start seeing that, you see, the Russell 2000 is also starting to outperform the S&P. The small caps are starting to outperform the big caps. And so what you're seeing here is you're seeing the beginning of the period. The market's telling you that you're seeing the beginning of the period where the Fed is going to start loosening. And for us, that means parabolic runs in the big coins. And you're starting to see it already. Solana, basically in the last couple of days, up at $225. ETH has had its run. Hyperliquid going up to $55, $56. Just look at Pump Fund. You know, like I'm very proud of this Pump Fund trade. And the reason why I'm very proud of this Pump Fund trade is because I don't really do very many dedicated videos on specific tokens, right? Like I don't do many of those anymore. But I had so much conviction in the Pump Fund trade. I had so much conviction in it that I actually made a full video around the fact that I'm going all in on Pump Fund. And I know the guys in Frontrunners they must have made, a lot of them might actually just retire and leave Frontrunners now because I made a full video around Pump Fund when it was at here it is. And that date was, let's look at when this was. Let's look at the exact date. August 5. Okay, that was when I made the video. August 5 was here. That's where August 5 was. Pump Fund was at 30 cents. I started buying it at 0.22. And I'm very proud of this because I really think that a lot of people are sleeping on Pump Fund. Did you know that Pump did more revenue than Hyperliquid in the last 7 days? Or Hyperliquid did 1 million more revenue in the last 7 days. And so you can't write this one off. And in fact, what I tweeted this morning is something I'm going to spend a lot more time speaking about. But ultimately, the one thing I think in this cycle, I'm a much smarter investor. I think I'm a much better investor. I'm a much smarter investor. For those of you who've been following me multi-cycles, you'll know that in my last cycles, I was maybe a little bit more reckless than I am in this cycle with what I bought and what I sold and what I spoke about. The biggest learning that I've had in this cycle is that the best way to make money in this cycle is just to double down on the winners and not to chase shiny objects. And I guarantee you that if you go back and you try and look at how you made money and how you didn't make money, I guarantee you that any of you that invested in the AI agents or any of us that invested in meme coins, I bet you've got nothing to show for that. But I bet you that those of you that bought Pump, Hyperliquid, Solana, 𝗬𝗎, and all that, I guarantee you that you guys are actually showing profits in the cycle. And so for me, the best thing that you can do in this part of the cycle, specifically because you know the altcoin season is about to come, bet on the fucking winners. And don't be moved by the shiny objects. I got to be honest with you guys. Every time I've bet on shiny objects, yeah, I might have bet a little bit of money here and there, but I've landed up giving it all back and my initial investment. I got nothing to show for all the AI agents that we invested in. I got nothing to show for it. For all the meme coins that we invested in, I've got very little to show for it. Like very little to show for it. The only place that my portfolio is actually showing real gains is investing in quality. And when you look at the market here, there is so much quality here. I mean, just look at all these options of quality that you have to invest in the cycle. And as I said to you guys 1,000,001 times before, if you feel like investing in Pump is not attractive enough for you because there's not much gains to be made, just buy Pump on 2x and 2x your gains and your losses. And then you've got the same market positioning as if you're going into memes and stuff like that. But you don't need to go into memes because you're not going to make the money there. But right now in the cycle, time to bet on the winners. Here's the winner for you. Mantle, that's a big winner for you. Solana, there's a big winner for you. Pith, kind of a winner. I mean, they've really got to show me, they've got to convince me for a lot longer. So anyway, guys, that's the story. Just a couple of things. So number one. Actually, okay, now that the main part of the show is done, I want to open the terminal and just see what's happening on the terminal. I want to just a couple of things. Number one, this BTCC special, I'm worried that they're going to end it very, very soon, right? For those of you who don't know what it is, they basically give you a 10% deposit bonus on anything you deposit. So you deposit $1,000, they give you $100. You deposit $10,000, they give you $1,000. Like it's a free bonus. And you basically can trade with that. Now, look, I know there's a lot of people that are signing up and they're just trading with the bonus and then they're withdrawing their funds. Like I'm not the one who told you to do that, but you can do that. There is a link below if you guys want to try it. Just go to, let me just go back to the show so you guys can see the link. Here it is. So there's a link below. Just sign up with the link below if you want that special, because that special is quite important. This weekend, I'm going to redo most of these Pionex bots. So they're all very good and they're all like the best Pionex bots. This weekend, we're going to have a workshop where I'm going to go through all of them and just make sure that my ETH bot is the right ETH bot and my Sol bot is the right Sol bot and my Pump bot is the right Sol bot. They are all right, but I just want to refine them. This weekend, look out for that show if you want to do it. And there goes the news terminal. Let's quickly look at the news terminal. Where is my news terminal? Let's have a look here. I've got I wish you guys could see this, but I've got about 35 different screens open here. So I have no idea where things are on my monitors here. All right, there's the news terminal. Now, for those of you who don't know what the news terminal is, it scrapes data from all the best sources. It brings them to you very, 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 very quickly in a matter of milliseconds. Like you can see 685 milliseconds, 677. And it allows you to take trades immediately from the news. Now, when you do that, you can land up making a ton of money. Reason why I'm talking about it again now is because up until end of September, you are going to pay $99 a month to sign up and $199 after 3 months. After that, it's going to be $299 after 3 months, which means that your time is very limited if you want to try the news terminal. This is a very, very, very good way to make money because as news comes out, you can trade on the news, and like the time to execution on the news is ridiculous. Like, look, watch this. I'm going to show you. Let's assume that this news came out now. Let's just quickly. Okay, let's assume that news came out now. Watch how quickly I'm in the trade. I'm in. That's it. And I'm out. It's like one button. Yeah, you can hear. Look how much news is coming out now. Bang, bang. Yeah. All right, chaps. I will see you guys again tomorrow. Until then, it's going to pump, guys. So trade well, my friends.